So in the second quarter of 2026, over $1.5 billion of new money walked through the doors of a single American bank every single day.
Yeah, which is just, it's a staggering number to even try to visualize.
Right. It's basically $1 million a minute, accumulating relentlessly hour after hour, totally regardless of what the stock market was actually doing on any given day.
And the most fascinating part about that massive accumulation of capital is that they barely even had to lift a finger to get it.
Exactly. So today on the deep dive, we are opening up the Morgan Stanley Q2 2026 earnings call transcript. And we're really trying to figure out how a financial institution automates the capture of wealth.
Because it fundamentally changes how we think about banking, right?
Yeah.
You stop looking at it as just this, series of individual transactions.
Yeah, like me going to an ATM or whatever.
Right. And you start realizing that what they have actually built is an ecosystem, one designed to catch capital at the exact moment of its creation.
It's wild. Now, we're going to break down this earnings call today. And I want to be really clear right up front that you don't need to be some Wall Street trader to find this stuff relevant.
No, not at all.
This transcript is not just, a boring spreadsheet of quarterly profits. It's really a live blueprint of the global economy.
Definitely. When a firm commands this much market share, their internal planning documents basically serve as a macroeconomic forecast for everyone else.
Exactly. So here's the roadmap for today. We're going to look at this through 4 key lenses. First, the headline numbers, then the story behind those numbers.
Which is where the real mechanics are.
Right. Then we'll get into management guidance, what they're explicitly saying about the future, and finally, the bottom line. So what this means for the structural health of the markets going forward.
I like it. Let's get into it.
Okay, let's start with the immediate scoreboard for the first half of 2026, because you really have to understand the current velocity of this bank before you can understand their future strategy,
Yeah, the scale is just structurally massive.
So the top line numbers for Q2. Revenues exceeded $21.3 billion. Earnings per share sat at 3.46. But looking closely at the transcript, management specifically noted that this EPS figure excludes DVA.
Which is such a crucial distinction. It often gets buried in the footnotes, honestly, but it tells you a lot about how management wants the market to view their core operational health.
So break down DVA for a second, because debt valuation adjustment sounds incredibly obscure.
It does. It sounds like pure jargon. But it essentially dictates whether a bank's earnings are real cash profits or just like accounting mirages.
Okay, a mirage. How does that work?
Well, DVA is one of the more counterintuitive accounting rules in finance. It has to do with how a bank values its own debt on its balance sheet. So let's say a bank issues bonds, right?
Right, they borrow money from the public.
Exactly. But suddenly the bank's own credit rating deteriorates. The market looks at the bank and says, you're riskier now. So because the bank is riskier, the market value of the debt they previously issued goes down.
Because investors are going to demand a lower price for taking on that increased risk.
Correct. But here is the weird accounting quirk. Because the market value of the bank's liabilities just decreased, the accounting rules actually require the bank to record that drop in liabilities as a profit on their income statement.
Wait, really? So perversely, a bank can look like it's making a massive profit simply because the market thinks it's closer to defaulting on its debt.
Entirely. It's totally backwards.
Which is completely disconnected from their actual business, right? Like advising clients or trading stocks. It's just phantom income.
Pure phantom income. So by explicitly stating that their 3.46 EPS excludes DVA, Morgan Stanley's leadership is basically drawing a line in the sand.
They're saying, look at our actual cash engine.
Right. They're telling investors we aren't relying on accounting quirks related to interest rate spreads on our own debt to show you profitability. This is cold, hard cash generated by the business.
And when you zoom out to the entire first half of 2026, that pure operating engine delivered $42 billion in revenue. EPS was 6.90. And they reported a metric that kind of seems to defy the gravity of modern banking, which is their return on tangible common equity.
Yeah, the ROTCE.
Right, the ROTCE. It pushed toward 27%. Management specifically noted it hit 26.6%.
I mean, that ROTCE figure is the linchpin of this entire earnings report. It measures how effectively a bank is using the hard physical cash its shareholders have provided to generate profit.
So we strip out all the intangible assets, right? Like the goodwill they acquired when they bought E-Trade or Eaton Vance.
Exactly. You ignore the fluff and just look at the raw, tangible equity. And for context here, in the years following the 2008 financial crisis, new regulations required banks to hold so much capital that generating a 10 or 12% return on equity was considered like an absolute triumph.
It was a total slog. Banks were drowning in regulatory capital requirements.
Right, which mathematically depresses your return on equity because the denominator, the equity you're forced to hold, is so massive. So for a globally systemically important bank to generate a 26.6% ROTCE in a highly regulated environment.
It just implies an extraordinary degree of operating leverage.
Unprecedented, really.
Which means the cost to generate their next dollar of revenue is shrinking. They noted an efficiency ratio of 65% year to date. So for every dollar of revenue, 65 cents goes to expenses.
Like compensation, real estate, technology, all of that.
Yeah, leaving 35 cents of pure margin.
And that margin expansion is happening despite the fact that they are heavily, heavily investing in AI and data infrastructure.
Not dragging them down.
No, the structural mechanics show that their tech investments aren't just a cost center. They're actively suppressing headcount growth and administrative friction as the asset base scales up. The machinery scales exponentially while the costs just scale linearly.
Wow. And that scaling brings us to a major psychological and, I guess, structural milestone they crossed this quarter. Total client assets across their wealth and investment management divisions officially hit $10 trillion.
10 trillion?
Yeah, specifically $8 trillion in wealth management and $2 trillion in investment management.
That fundamentally changes the firm's relationship with the broader market. When you cross the 10 trillion threshold, you transition from being a participant in the market to basically being a foundational layer of the market itself.
Right. We often try to conceptualize numbers like 10 trillion by comparing them to the GDP of a country. Like, oh, it's bigger than Japan or whatever. But I don't think that does justice to what controlling 10 trillion of investable assets actually means for a bank. This isn't just static money sitting in a vault.
No, it is highly active capital.
If we look at the mechanics of market power, controlling 10 trillion gives you immense leverage in liquidity provision and asset pricing.
Right. Oh, absolutely. When Morgan Stanley's investment management arm decides to shift even a fraction of a percent of that capital from equities into fixed income or from U.S. markets to emerging markets.
They are moving tens of billions of dollars in a single day.
Yeah, that dictates the flow of global liquidity. And furthermore, think about corporate governance. The sheer volume of proxy voting power contained within 10 trillion means this single institution holds massive sway over the boardrooms of the world's largest companies.
Yeah, that's wild to think about. You're identifying the structural moat of modern megabanks. Size just begets size.
Exactly. When sovereign wealth funds or massive institutional pensions are looking for a counterparty to execute a complex multi-billion-dollar trade without disrupting the market price, they can only go to institutions that have the internal liquidity to absorb it.
Because if they went to a smaller bank, the trade would leak and ruin the price.
Right. The 10 trillion asset base essentially acts as a gravitational field. It attracts more institutional capital simply because it is the only place large enough to safely house it.
And speaking of housing it safely, that requires a heavily fortified structure, which is why management spent significant time on the call discussing their balance sheet.
The fortress balance sheet.
Right. They highlighted total spot assets at $1.7 trillion. But the metric they were most focused on was their capital buffer. Over the last 10 quarters, they accreted $18 billion in CET1 capital, pushing their CET1 ratio to 14.8%.
Okay, so CET1, or Common Equity Tier 1, it is the absolute bedrock of a bank's capital structure. In the regulatory framework of Basel III, CET1 is the highest quality capital.
Meaning what exactly?
It means it consists of highly liquid, easily verifiable assets, mostly common stock and retained earnings. This is the shock absorber. If the economy nosedives and loans start defaulting, CET1 is the capital that absorbs those losses before depositors or senior bondholders take a hit.
Got it. And the regulators mandate a specific minimum CET1 ratio based on how risky the bank's assets are, which are called risk-weighted assets. But management pointed out that their 14.8% ratio currently sits more than 300 basis points above their regulatory requirement.
Let's translate those basis points into the actual mechanics of the balance sheet for a second. A basis point is 1/100th of a percent. So 300 basis points is in excess of 3%.
Okay.
When you apply 3% to Morgan Stanley's massive risk-weighted asset base, you are talking about billions of dollars in pure, unencumbered excess capital, just sitting there above and beyond what the Federal Reserve requires them to hold after the most recent stress tests.
Okay, let's unpack this for a second. Because hoarding that much excess capital during a period of record profitability feels kind of counterintuitive to me. In a booming market, you generally want to deploy that capital to generate yield, not just let it sit idle. Unless, they're actively building a war chest. Management mentioned this gives them strategic flexibility.
Which is absolutely corporate speak for having the financial firepower to act opportunistically when competitors are constrained.
Right. They aren't hoarding it because they fear an imminent collapse. They're hoarding it because the geopolitical fracturing of global supply chains, which we'll get into later, is going to create sudden distressed acquisition targets.
Exactly. If a regional bank stumbles or a foreign wealth manager needs a bailout, Morgan Stanley can step in immediately without needing to raise capital in a panicked market.
And in the meantime, they're rewarding the shareholders for their patience. Because the business organically generates so much cash, they announced a 15-cent dividend increase, taking the quarterly dividend up to 1.15 per share. And on top of that, they repurchased $1.5 billion of their own common stock in Q2 alone.
Which mathematically supports that EPS growth we talked about earlier.
Because they're retiring shares and concentrating the earnings over a smaller pool of outstanding stock, right?
Right. It creates a self-reinforcing loop of shareholder value. The fortress balance sheet isn't just a defensive mechanism, it's an offensive tool that reduces their cost of capital relative to all their peers.
Okay, so that transitions us perfectly into the story behind the numbers. The mechanics of where this cash is actually coming from. Because it's one thing to look at the scoreboard, it's another to open up the engine block and see how the cylinders are actually firing. And for Morgan Stanley, the most powerful engine right now is clearly the wealth management division.
Oh, without a doubt. The wealth management figures from Q2 are indicative of a structural shift in how banking operates today. They reported $8.9 billion in revenue with a pre-tax margin of 30.5%.
Generating a 30% margin on a $9 billion revenue base is just phenomenal. But the number that demands absolute scrutiny here is their organic net new assets, or NNA. They brought in $148 billion in net new assets in a single quarter.
Which circles right back to your opening thought, over $1.5 billion flowing in every single day.
Right. So how does a bank actually capture $148 billion in 90 days? Because the transcript reveals a very specific architectural strategy here. Management noted that over half of this NA came from stock plan IPO flows within their workplace channel.
This is where we need to look really deeply at the mechanics of corporate capitalization tables and the private equity lifecycle. Because Morgan Stanley has essentially engineered a financial catchment system.
A catchment system?
Yeah. They aren't waiting for the rain to hit the river, so to speak. They are catching the wealth at the exact moment of precipitation.
Which requires establishing the infrastructure years before the wealth actually materializes. They noted on the call that they cover 70% of the top 100 unicorns, privately held startups valued over $1 billion.
To understand how powerful this is, you have to look at their integration with platforms like Carta, which manage the capitalization tables, the cap tables for private startups.
A cap table is just a ledger that shows who owns what percentage of a company, right?
Correct. When an engineer gets hired at a hot new AI startup, a significant portion of their compensation is in restricted stock units, or RSUs.
Right. And those RSUs are basically lottery tickets. They have theoretical value on paper, but the employee can't buy groceries with them. They're completely illiquid.
Exactly. Now, Morgan Stanley's strategy over the last decade was to become the primary administrator for these corporate stock plans. They provide the software and the back-end infrastructure that tracks all these millions of shares for the private companies.
Okay, so they're doing the administrative grunt work.
Yes. So fast forward 5 years, the startup decides to go public via an initial public offering, an IPO.
The moment of the liquidity event.
The precise moment. When that IPO bell rings, all those illiquid RSUs held by the engineers, the executives, and the early investors suddenly transform into highly liquid, publicly tradable shares. Millions of dollars of real actionable wealth are created in an instant.
And because Morgan Stanley is already administering the stock plan, the employee's new fortune isn't wired out to a competitor like Charles Schwab or Fidelity. It simply unlocks within an account that Morgan Stanley already controls. The wealth doesn't even cross the street.
They bypass the entire customer acquisition cost model that plagues traditional retail banking. Historically, a bank would have to spend millions on advertising, premium credit card rewards, and physical branch locations just to lure a high net worth individual away from a competitor.
Yeah, the old way was so expensive.
Morgan Stanley realized that if you embed yourself in the HR departments of the fastest growing tech companies in the world, you acquire the clients before they are wealthy.
Which creates this impenetrable structural moat. If you capture 70% of the top 100 unicorns, you have essentially monopolized the pipeline of future tech millionaires.
However, I have to push back a bit here because reading this dynamic in the transcript prompted a major question from the analysts and, frankly, from myself.
Okay, what is it?
If over half of their $148 billion in new assets came from IPO flows, doesn't that make the entire wealth management engine terrifyingly reliant on the IPO market? Like, we have seen the IPO window slam shut for years at a time. If the tech market cools, doesn't this entire wealth funnel just dry up? It is a critical vulnerability to probe, and you're right to ask it. Management actually spent significant time addressing the broader mechanics of the workplace funnel to mitigate that exact fear. The IPO flows are the massive, volatile injections of capital, the tidal waves, if you will, but the foundational current of the business is far broader than that.
Right. They pointed out that the workplace funnel also includes the administration of corporate 401k plans and the legacy self-directed accounts from their acquisition of E-Trade.
Exactly. They are managing the retirement accounts for massive Fortune 500 companies. That is steady, recurring payroll deduction money that flows in regardless of whether the IPO window is open or closed. It's biweekly automated asset gathering.
And they noted that across all these channels, they now have 20 million client relationships. So the core strategy here isn't just IPOs, it's asset migration.
Let's look at how that migration functions mechanically. A 25-year-old employee starts contributing to their 401k through their employer, and maybe they have a small self-directed E-Trade account where they buy a few stocks on the side. Morgan Stanley makes very little margin on that pure administrative relationship.
Right, just a low-margin utility service.
Exactly. But as that employee ages, their account balances grow. Maybe they inherit some money, or maybe their E-Trade account finally crosses $100,000. Morgan Stanley is deploying sophisticated data analytics. They specifically mentioned a tool called Lead IQ to monitor these 20 million relationships in real time.
So the algorithm is just scanning for behavioral triggers or asset thresholds.
Yes. So when the algorithm flags that an account has reached a certain size, or maybe the user is searching for estate planning documents on the E-Trade platform, it instantly alerts a human financial advisor.
Oh, wow. So the system essentially hands the advisor a perfectly warm lead with complete financial context.
Exactly. The advisor reaches out and says, hey, you've built up a significant nest egg here. It might be time to transition from a self-directed portfolio into a fully managed fee-based relationship where we handle your tax loss harvesting, your estate planning, and your alternative investments.
And when the client says yes, the assets migrate from a low-margin utility bucket into a high-margin advisory bucket, which charges a percentage of assets under management every single year.
That is the mechanical engine behind the 30.5% margin. They have basically automated the farming of their own client base.
It creates a perfectly closed-loop ecosystem. You bring them in via the workplace at zero acquisition cost, you hold them in low-cost administrative accounts while they build wealth, and you algorithmically harvest them into premium advisory services precisely when they actually need it.
It is a phenomenal structure. But you have to remember, the wealth management side is only half of the Morgan Stanley equation.
All right. The transcripts also revealed a massive resurgence in their institutional securities division, which is the traditional investment bank. They posted $11 billion in revenue for the quarter.
And the composition of that revenue tells a very distinct macroeconomic story. Investment banking revenues surged 58% year over year, hitting $2.4 billion.
Which is huge. To understand the magnitude of a 58% jump for a business of this size, we have to break down the specific components. Advisory revenues, which is primarily driven by mergers and acquisitions, M&A, came in at $798 million. Equity underwriting, which includes managing IPOs and secondary stock offerings, hit $851 million. And fixed income underwriting, which is issuing corporate debt and bonds, was $788 million.
If we synthesize those three numbers, we can see the exact pivot point of the current corporate financial cycle. For the last 2 to 3 years, the dominant theme in corporate boardrooms was managing the debt cycle.
The hangover from the zero interest rate era, right?
Precisely. We had a decade of virtually free money, followed by the most aggressive rate hiking cycle by the Federal Reserve in modern history. Corporations were just terrified of their debt maturing in a high-rate environment.
So the bulk of investment banking activity was fixed income focused, helping companies refinance debt, issue new bonds, manage their liability structures.
Yeah, it was a totally defensive posture.
But looking at the $851 million in equity underwriting and the $798 million in M&A advisory, That defensive posture is officially over.
It has decisively flipped to an offensive posture. A booming equity and strategic advisory cycle means that C-suite executives finally have the confidence to look outward. The cost of capital has stabilized. They aren't just trying to survive their debt loads anymore. They are aggressively issuing equity to fund expansion, and they are buying their competitors.
And providing the liquidity for all of that market action is their equities franchise, the actual trading desks, which delivered an exceptional $6.3 billion quarter.
The mechanics behind that $6.3 billion are fascinating too. Management highlighted higher average client balances in their prime brokerage division.
Now, prime brokerage is essentially the specialized bank for hedge funds, right? Like they provide the leverage, the stock borrowing for short selling, and the trade clearing.
Exactly. When prime brokerage balances are up, it means the hedge funds are highly active and they're employing leverage to magnify their returns. Management also cited strong activity in Asia and highly active derivatives markets.
Meaning they're writing complex options?
Yeah, they've invested billions into dynamic risk management software that allows them to instantly price and trade complex derivatives for institutional clients across global markets, entirely regardless of market volatility.
Which means we are looking at a fully integrated financial machine here. The investment bank takes the unicorn public and collects the $851 million in equity underwriting fees. Then the wealth management division catches the resulting IPO wealth in the workplace channel, driving the $148 billion in net new assets. And the equities trading desk manages the resulting market liquidity for the hedge funds trading that new stock.
Every single division feeds the other. It is the realization of the integrated firm model they have been building for over a decade. The flywheel is fully operational.
Okay, with the current machinery mapped out, let's move to the third lens, which is the most forward-looking and frankly staggering portion of the earnings call, management's guidance. Specifically what they term the AI supercycle. Now, we hear about AI constantly, but the capital expenditure numbers, the CapEx discussed on this call, reframe the entire scale of this technological shift.
Because when a bank like Morgan Stanley discusses technology, they don't talk about the software capabilities of a large language model. They don't care about the chatbot. They talk about the concrete physical infrastructure required to run it. They look at the supply chain of compute.
And the numbers they laid out for data center CapEx show a violent acceleration. Management mapped the progression of Wall Street's estimates over just the last few months. Late in 2025, the consensus forecast for global data center CapEx in 2026 was estimated at $575 billion. But as of this call, that figure has already been revised up to $850 billion.
A $275 billion upward revision for a single calendar year is practically unheard of in capital forecasting. It indicates that the hyperscalers, companies like Amazon, Microsoft, and Google, are realizing the compute bottleneck is far, far more severe than anyone anticipated.
And the trajectory steepens dramatically from there. The CapEx projections for 2027 just jumped from $700 billion to $1.3 trillion. And management noted that by 2028, we could be looking at a $1.5 trillion annual spend just to build the data centers, the cooling systems, and the custom silicon required to process these AI workloads.
To contextualize a $1 trillion spend cycle, management referenced a historical heuristic regarding technological infrastructure. Every major paradigm shift in technology historically requires a 10x increase in compute capacity compared to the preceding cycle.
They use this shift from on-premise servers to cloud computing as the baseline, right? The build-out of the global cloud infrastructure over the last 15 years required roughly $1 trillion total capital expenditure.
So applying that 10x heuristic to artificial intelligence, Morgan Stanley is preparing its institutional operations for a $10 trillion investment cycle over the next decade.
A $10 trillion physical foundation, which fundamentally shifts how we should think about AI as an investment theme. Instead of focusing on who builds the best software, we need to look at the sheer industrial reality of building a data center.
A modern hyperscale data center is a massive industrial undertaking. It requires acquiring hundreds of acres of land, securing long-term power purchase agreements for gigawatts of electricity, installing massive liquid cooling infrastructure, and acquiring tens of thousands of specialized GPUs.
It is way less like building a software product and much more analogous to a city tearing up its physical streets to upgrade the electrical grid so it can support millions of new electric vehicles.
That's a great analogy.
You cannot drive the EV until the city lays the high voltage cable. And you cannot train the next generation AI model until the concrete is poured and the fiber optic cables are laid.
And that infrastructure build requires capital on a scale that individual tech companies, even the largest ones, simply cannot finance entirely out of their own cash flows. This is where the structural role of the investment bank comes back into play.
Management made it very clear that in a 10 trillion cycle, Morgan Stanley serves as the critical capital intermediary, the picks and shovels of the gold rush.
The mechanics of capital intermediation at this scale involve syndicating risk. Let's say a hyperscaler wants to build a $5 billion data center campus in the Midwest. Morgan Stanley structures the financing.
They aren't just lending them $5 billion out of their own pocket.
No. They might arrange a massive syndicated loan where they divide that $5 billion debt among 50 different global banks. They might match the project with sovereign wealth funds from the Middle East looking for long-term infrastructure yield. Or they might structure specialized private credit vehicles.
They possess the institutional architecture to take the massive, unquenchable capital demands of the tech sector and match them with the massive, unquenchable yield demands of global institutional capital.
Exactly. They act as the central routing switch for the 10 trillion. And for every single dollar they route through their syndication desks or advisory teams, they capture a fee. The technology itself is completely irrelevant to them. The capital flow required to build it is their actual product.
And management emphasized that we are only roughly 10 to 15% of the way through this investment cycle. We are in the earliest stages of the build-out. But AI infrastructure isn't the only macroeconomic driver management sees on the horizon, is it?
Not at all.
They also provided pointed guidance on the broader M&A landscape, explaining why there's a massive dam of pent-up corporate restructuring about to break.
The historical timeline they laid out to explain this M&A backlog is honestly a masterclass in behavioral finance. They argued that for the better part of 5 years, corporate behavior has been artificially paralyzed by a succession of macro shocks.
It started with what they termed financial repression, the era of 0% interest rates. When the cost of capital is essentially zero, corporate capital allocation becomes highly distorted. Companies didn't need to engage in strategic, difficult mergers to grow. They could just borrow free money and buy back their own stock to boost their share price.
The free money era subsidized inefficiency. But as that era ended, it was immediately replaced by a period of perceived overregulation. Management noted that corporate boards became terrified of attempting large-scale mergers because the regulatory environment was aggressively anti-consolidation.
Companies just assumed the government would block any major deal, tying them up in years of expensive litigation, so they simply stopped trying.
Then you layer on the operational chaos of the global pandemic, followed immediately by the violent historic spike in inflation, which forced the Federal Reserve to hike interest rates at unprecedented speeds.
The volatility of the jet markets made it mathematically impossible to price a leveraged buyout. If you don't know what your interest payments are going to be next month, you cannot accurately value a multi-billion-dollar acquisition.
Right, so you have a 5-year period where corporate America is trapped in the mud, basically. Distorted by free money, scared of regulators, operationally broken by COVID, and financially frozen by inflation.
But management's core thesis on this call is that the mud is finally drying.
We are entering what they described as a normalization of regulation. The regulators are showing a willingness to engage with and approve rational transactions that make economic sense. The interest rate volatility has stabilized, meaning debt can finally be accurately priced. The result is a massive release of pent-up strategic ambition.
And the primary pressure valve forcing this release comes from the private equity industry.
The mechanics of private equity fund life cycles dictate that this M&A volume must happen. It isn't optional. Private equity firms, or sponsors, operate on strict timelines. They raise a fund from institutional investors, they buy a portfolio of private companies, and they generally have a 10-year window to improve those companies, sell them at a profit, and return the capital to their investors.
Right. You cannot hold a company forever in private equity because the internal rate of return, the IRR, mathematically decays the longer your capital is locked up.
Precisely. If a PE firm bought a company in 2019, they have been holding it through all those macro shocks we just discussed. They are now 5, 6, 7 years into their fund life cycle. They're facing immense pressure from their own investors, the limited partners, who are demanding their cash back so they can allocate it elsewhere.
Which means the private equity sponsors have no choice. They are forced sellers. They must exit these investments, either by taking the companies public in the IPO market or by selling them to larger corporate buyers in the M&A market.
That structural necessity to exit is going to flood the investment banking pipelines with supply over the next 24 to 36 months.
But beyond the financial mechanics of private equity, Management highlighted a real-world physical driver of corporate restructuring, too, the return of geopolitics.
Yes, we are witnessing the unwinding of 30 years of globalization.
For decades, the ultimate corporate strategy was supply chain optimization. You found the single cheapest place on earth to manufacture a component, usually China, and you built a hyper-efficient, just-in-time supply chain that ran directly from that factory to the American consumer.
But geopolitical tension has rendered that optimized model catastrophically fragile. Tariffs, trade wars, and the threat of regional conflicts mean that a single disruption in one country can halt production globally.
So corporate boards are being forced to execute a strategy of supply chain redundancy, often called friendshoring. You can no longer rely on a single factory. You must duplicate your manufacturing capabilities in geopolitically aligned nations, building new hubs in places like India, Vietnam, or Mexico.
The mechanics of carrying down a decades-old global supply chain and physically rebuilding it across multiple new sovereign territories require an unfathomable amount of capital. It requires spinning off vulnerable divisions, acquiring local competitors in new markets to secure distribution rights, and issuing massive amounts of corporate debt to build new factories.
Which means the fracturing of global trade, the exact thing that terrifies geopolitical analysts, is actually a structural revenue generator for the investment banks tasked with rewiring the system.
It really is.
When a Fortune 500 company has to spend $5 billion to move a critical supply chain out of a hostile region, Morgan Stanley earns the advisory fees on the divestment, the underwriting fees on the debt issuance to fund the move, and the M&A fees on acquiring the new local facilities. Geopolitical friction literally creates financial velocity.
It's a perfect encapsulation of their value proposition. The more complex and uncertain the world becomes, the more premium clients are willing to pay for flawless execution and strategic advice.
Okay, having explored the data and the future projections, we need to transition to our final lens, the bottom line. How is Morgan Stanley actively positioning its own corporate structure to capitalize on these trends? How does a $10 trillion asset manager navigate this fractured world?
The first critical adjustment is realizing that Morgan Stanley is not just a proxy for the United States economy.
There is a very persistent myth in the financial media that because their wealth management division is so visibly dominant in America, the firm's overall health is entirely tethered to the American consumer.
Management aggressively debunked that on the call. They explicitly stated that they consider themselves an Asia house.
That structural positioning relies heavily on their relationship with MUFG, the Mitsubishi UFG Financial Group, which is one of the largest banks in Japan. They own a 25% stake in Morgan Stanley.
The MUFG partnership is a fascinating piece of financial engineering. It stems from a massive capital injection during the 2008 financial crisis. But instead of remaining a passive investment, the two firms have deeply intertwined their operations. On this call, management highlighted a joint initiative called Launch 2.0,
which essentially fuses their capabilities in the region. They are integrating their institutional equity content, their research teams, and their foreign exchange operations. If a Japanese corporation wants to execute a cross-border acquisition, they have the local balance sheet of MUFG paired with the global M&A advisory expertise of Morgan Stanley working in tandem.
And this footprint extends far beyond Japan. Management pointed out highly profitable, booming operations across Taiwan, Korea, and specifically India. They emphasized a crucial point on the call, that certain geographies are no longer a monolith.
Because for 20 years, when Wall Street said Asia, they primarily just meant China.
But the geopolitical supply chain fracturing we just discussed is rapidly changing that dynamic. As capital flows out of Chinese manufacturing hubs, it is immediately flowing into Indian infrastructure and Japanese corporate restructuring. By establishing deep, localized operations across the entire continent, Morgan Stanley can capture the capital flight.
It creates non-correlated revenue streams. If the U.S. consumer pulls back due to domestic inflation, but Indian equities are surging due to manufacturing inflows, Morgan Stanley's global revenue floor remains completely stable. They are geographically hedged against localized recessions.
Which brings us back to that $18 billion excess capital cushion. They have the geographic footprint, they have the market tailwinds, and they have the cash. The analysts on the call were desperate to know, are they going to use that capital to buy a massive competitor?
The classic organic versus inorganic growth debate. With their stock price trading at premium valuations and capital readily abundant, it seems like the perfect time to pull the trigger on a massive acquisition to instantly boost market share.
But management's response demonstrated a very strict financial discipline. They stated unequivocally that their primary goal where the first dollar of reinvestment always goes, is feeding their organic business.
Meaning they want to put that capital directly into the market to fund their existing clients, expanding their own loan book, funding their prime brokerage clients, investing in the lead IQ algorithms.
Because the return on equity for their organic operations is already pushing 27%, it is mathematically very difficult to find an acquisition target that won't dilute that level of efficiency.
However, they didn't rule out inorganic growth entirely. They maintain that they have a ruthless discipline for what they term bolt-on acquisitions.
A bolt-on acquisition is highly strategic. You aren't buying a massive equal-to-merge balance sheets. You are acquiring a smaller, specialized target that instantly provides a capability you lack.
Management pointed to their history of successful bolt-ons, like absorbing E-Trade to capture the self-directed retail market, or Eaton Vance to bolster their customized portfolio capabilities. But they set an incredibly high threshold for any future deals. The target must add adjacent capabilities, open attractive new geographical markets, or bring in distinct new client relationships.
And beyond the financial spreadsheets, they emphasize that cultural fit is a non-negotiable threshold. If the corporate culture of the target firm doesn't integrate smoothly with Morgan Stanley's risk management culture, they just walk away, regardless of how attractive the numbers look.
History is littered with the corpses of massive bank mergers that looked perfect on paper but failed miserably because the two trading floors fundamentally hated each other.
The friction of a bad cultural integration destroys more shareholder value than the acquisition could ever create.
So when we synthesize all these mechanics, the automated capture of $148 billion through workplace cap tables, the structural shift from debt issuance to M&A advisory, the $10 trillion AI infrastructure bottleneck, and the geographic hedging across Asia. What is the ultimate objective here? What is leadership actually communicating to the market about their identity?
The overarching theme of this earnings call wasn't just to celebrate a record quarter of revenue. It was a calculated effort to define their corporate valuation model. Management stated their ultimate objective is to build a durable franchise that delivers higher highs and, importantly, higher lows through the full economic cycle.
Raising the floor of profitability.
Exactly. Anyone can generate massive profits in a raging bull market when asset prices only go up. The true test of a financial institution's architecture is what happens when the market breaks, when volatility spikes, IPOs freeze, and the economy contracts.
By building this massive, closed-loop wealth management engine that generates steady fee-based income regardless of daily market swings, and coupling it with an opportunistic investment bank that profits from geopolitical friction, they are attempting to engineer a floor that is continually rising. Even in a terrible macroeconomic year, the sheer scale of the automated asset gathering ensures they remain wildly profitable.
And if you can mathematically prove to the market that your lows are continually rising, you fundamentally change how your stock is valued. You no longer trade at the volatile, low price-to-earnings multiple of a traditional trading shop.
You command the premium, compounding multiple of a durable wealth franchise. They are essentially telling Wall Street to stop treating them like a bank and start treating them like a utility.
A utility that controls $10 trillion of global liquidity.
We have unpacked a tremendous amount of structural engineering today. We looked at the sheer gravity of 10 trillion assets and how it dictates market flow. We examined the mechanics of the workplace funnel, catching unicorn wealth the exact second an RSU vests into liquid cash. We explored the private equity pressure cooker, driving the 58% surge in investment banking, and how the tearing up of global supply chains creates massive advisory revenues.
And we mapped out the 10 trillion physical infrastructure required to build the AI supercycle, and Morgan Stanley's role as the central capital router for that build-out.
But I want to leave you with a final thought, something for you to consider that builds on the mechanics we've discussed today. We talked extensively about the AI data center build-out. Management foresees a decade of relentless trillion-dollar expenditures. But hidden in the transcript was a very brief, almost casual mention by management of technology and power bottlenecks.
Power bottlenecks.
When you look at the physical reality of a 10 trillion compute build-out, it raises a massive structural question. What happens when this infinite digital ambition, the desire of hyperscalers to build AI models exponentially larger year after year, crashes into the finite physical reality of the global energy grid? Data centers do not run on code. They run on raw megawatts.
You can syndicate all the capital in the world, but you cannot instantly syndicate a nuclear power plant.
Which implies that the next great wealth transfer might not be dictated by which tech company codes the smartest AI algorithm, or which semiconductor company prints the fastest silicon chip. The ultimate bottleneck, and therefore the ultimate source of pricing power, might simply belong to whoever controls the baseload electrical power required to plug these data centers in.
Wow, that's a fascinating angle.
If artificial intelligence becomes the engine of the global economy, then the physical energy grid becomes the ultimate choke point. It shifts the entire paradigm from a digital race back to a brutal physical infrastructure race. Keep looking past the obvious numbers and keep questioning the physical mechanics behind the financial data. Because the structural realities of the economy are always shifting, and you have to know exactly where the real bottlenecks are being built. Thank you for joining us on this deep dive.